Welcome to this explainer. Today, we're diving deep, and I mean really deep, into a strict analytical deconstruction of the systemic mechanisms driving capital gains tax deferral and advanced wealth preservation. Now, based on a comprehensive expert report we're analyzing today, we aren't just looking at surface-level financial tips. No way. Instead, we're going to treat the tax code like an intricate machine. We're popping the hood to see exactly how the most sophisticated wealth-building engines actually operate. If you've ever wondered how these massive institutional-level portfolios manage to scale exponentially without getting totally suffocated by taxes, well, you are in the exact right place. We're going to break down the cause and effect relationships that govern capital retention, and we'll examine the implicit rules that the absolute most successful investors leverage every single day. So here's our roadmap for today: the capital gains liability, the mechanics of the 1031, the sequential deferral loop, terminal tax elimination, opportunity zone alternatives, and finally some strategic conclusions. Let's get right into it. Starting off with Section 1, the capital gains liability, or what we can call the baseline burden. Okay, let's define the core trigger here. A capital gain is essentially the profit you realize upon the sale of an asset. Mathematically, it's pretty straightforward, right? It's just the difference between your sale price and your original purchase price. But if we look at this from a systems perspective, this specific mathematical delta is what triggers an immediate and honestly severe taxable event. In the wealth compounding formula, continuous reinvestment is absolutely the ultimate driver. The very moment you sell or, realize that gain, you are introducing a massive amount of friction. You're effectively draining the fuel right out of your compounding engine. The government views this realized profit as income, which means that without a highly specialized strategic mechanism in place, a huge chunk of your hard-earned equity is just immediately eroded. It fundamentally stalls your momentum. And when we analyze this erosion on a timeline, the contrast is just stark. Short-term capital gains, meaning you held an asset for less than a year, are treated as ordinary income. That means taxing your profit at rates up to a staggering 37%. That is a rapid, aggressive extraction of your capital. On the flip side, long-term capital gains do reward patience. Holding an asset for over a year drops that liability down to a maximum of 20%. But here's the thing. While it's a heavily discounted rate, it is still a massive restrictive burden on your capital's ability to compound over decades. Think about it. Every single dollar paid in taxes is a dollar that can no longer generate its own subsequent returns. Either way, whether it's short or long-term, realization equals severe portfolio erosion. Moving on to Section 2, mechanics of the 1031, and how we go about intercepting that erosion. So the tax code actually offers a specific, highly regulated pathway to completely defer that capital gains liability, and it's commonly known as a 1031 exchange. This is a strict statutory mechanism used by the experts to intercept that capital erosion and retain liquidity. But, and this is a huge but, it requires absolute adherence to chronological procedural rules. Step 1 is selling the original appreciated property. Simple enough. But Step 2 introduces a notorious challenge. You have to identify a like-kind replacement asset within a rigid 45-day statutory window. The clock is ticking the second you close. Finally, Step 3 mandates that you reinvest all of those proceeds into a property of equal or greater value within 180 days of the sale. And here's the kicker. You cannot touch the cash, not even for a minute. It has to pass through an independent third party known as a qualified intermediary. Any leftover cash or even debt reduction is analytically classified as what they call boot, and that triggers instant taxation. Flawless execution is literally the only way to push the liability into the future. The absolutely crucial mathematical takeaway here is 100%. When you properly execute this exchange and avoid all of that boot we just talked about, you retain 100% of your deferred tax capital right within your own operational control. Instead of handing 20% or 37% of your profit over to the government, you get to keep it working for you. Analytically speaking, this functions exactly like an indefinite, zero-interest loan directly from the government. You are utilizing funds that would otherwise be permanently lost to go out and acquire larger, higher cash-flowing assets. It magnifies your wealth generation power exponentially, all by simply avoiding the frictional cost of realization. Section 3, the sequential deferral loop, where we really start compounding growth. Now, the true power of this system is unlocked when these single deferral events are logically strung together into an ongoing loop. Just imagine how this builds across a lifetime. Say in year 1, you make your initial acquisition. By year 5, the property appreciates, and instead of selling, taking a tax hit, and losing momentum, you execute your first exchange. You move 100% of your equity into a larger asset. Then you repeat this exact process in year 15. By year 30, you've leveraged untaxed equity to scale into a robust, multi-asset portfolio. An investor who chooses to just realize gains and take a 20% tax haircut every decade, they are losing a massive percentage of their principal's earning power over time. By consistently avoiding realization, your principal remains wholly intact, fully capable of catching the next cyclical wave of appreciation with an ever-expanding capital base. And this brings us to a really well-known analytical axiom within the expert community. They say, swap until you drop. It's catchy, right? But it brilliantly summarizes the implicit assumption built deeply into this tax provision. You see, the goal for sophisticated investors is rarely a temporary deferral. The ultimate strategy relies on continuous, lifelong deferral. By treating the 1031 mechanism not just as a one-off transaction, but as a perpetual engine, investors constantly roll their equity forward. They are forever pushing the tax liability over the horizon, utilizing government-subsidized capital to relentlessly build their own private empires. Which leads perfectly into Section 4, terminal tax elimination, and resolving that deferral. So, we have to pose the central analytical question of this entire strategy. If you spend 40 years swapping properties, legally kicking the can down the road, and deferring hundreds of thousands or literally millions of dollars in taxes, does that deferral ever actually become elimination? I mean, with millions of dollars hanging in the balance, how are decades of compounding deferred tax liabilities eventually handled upon the investor's passing? Are the heirs suddenly walking into a massive inherited ticking time bomb of a tax bill? Well, the answer lies in a specific statutory mechanism called the step-up in basis. And honestly, it's the linchpin of the entire deferral strategy. Without it, lifelong deferral would just be a delayed disaster. Here's how it works. When an asset is passed to an heir upon the original owner's death, the tax code allows the cost basis of that inherited asset to be immediately adjusted up to its current fair market value. This is the exact legal mechanism that permanently and irreversibly erases the previously deferred capital gains liability. All those years of rolling exchanges, all that untaxed appreciation that was carried forward over decades, poof, it is entirely wiped clean from the ledger. Think about the sheer power of this provision in contrast. On one side, you have the original cost basis, which represents a massive looming capital gains tax on decades of appreciation if the asset were to be sold right before the owner passed away. But on the other side, through the step-up in fair market value, the heirs receive the asset with a zero capital gains tax liability attached to any of that prior growth. None. If the heirs decide to sell the entire portfolio the very next day, they pay absolutely nothing in accumulated capital gains. This represents a staggering mathematical gap that is completely forgiven, allowing vast wealth to transfer to the next generation entirely free of the predecessor's cumulative tax burden. It's truly incredible. All right, moving to Section 5, Opportunity Zone Alternatives. Let's look at some alternative engines. Now, beyond the strict like-kind parameters of the 1031, which is, just for real estate, we can analyze an alternative engine, qualified opportunity funds. Contrasting these two reveals some really critical, non-obvious trade-offs when it comes to risk and flexibility. With the standard 1031 exchange, sure, you gain indefinite deferral, but you are strictly limited to real estate. Opportunity funds, however, allow you to defer gains from highly volatile assets. We're talking stocks, business sales, or even crypto. The trade-off? You're mandated to deploy that capital into economically distressed areas, meaning you're absorbing significantly higher development risk. Plus, the deferral is not perpetual. It offers a fixed deferral window on the original gain. But here's the upside. If you hold the new investment for 10 to 30 years, any new capital gains generated by the fund itself become completely tax-free. So you're essentially trading the safe haven deferral loop of a 1031 for a fixed window in a higher risk zone, but with the massive upside of broader asset eligibility. And finally, Section 6, Strategic Conclusions, pulling out the system's level truths. Pulling all these deep mechanical findings together, we can synthesize the absolute laws of wealth preservation according to the expert data. First, we have to view capital gains strictly as a severe erosion of your portfolio's compounding power, not just a standard cost of doing business. Second, statutory deferral mechanisms act as a zero-interest liquidity engine, giving you the massive leverage to build empires using funds that would otherwise belong to the government. And finally, the step-up in basis acts as the ultimate finish line. It converts that lifelong deferral into absolute, irreversible tax elimination. This is the precise sequential formula that transforms standard tax compliance into an aggressive, multi-generational financial engine. So I want to leave you with a really provocative question to consider. Based on all the mechanical realities we've analyzed today, what is the true compounding cost of unnecessary realization events currently sitting in your portfolio? Really think about it. Every single time you sell an asset without a deferral mechanism in place, you are halting your compounding momentum and losing principal. I highly encourage you to analytically audit your own assets, identify any exposure you might have to premature tax liabilities, and ruthlessly evaluate your friction points. Thank you so much for joining me for this explainer. Keep analyzing, keep optimizing, and I'll catch you next time.